Hello and welcome to another video on accounting standards. Again, I would like to remind here, if you're preparing for your HKICPA exam or any other professional accounting exam, this is a summarized version of the standard, whereas you can always refer to the detailed standards or your learning packs or your notes on the standards. So in today's video, we are going to look at HKAS 37, which is on provision, contingent liability, and contingent assets. It's quite tested in the exam from time to time. So it's really important to understand what this standard is about, and hope this video can help you understand this standard very well in a short period of time. So let's get started and see what we are going to discuss in this video. So in this video, we are going to look at the definitions of a provision, contingent liability, and contingent assets. The second thing that we are going to see is the difference between a provision and a contingent liability. Often students do confuse between a provision and a contingent liability. So we are going to look at, it's very basic, very simple. So we are going to look at the difference between provision and a contingent liability. Then following this, we are going to look at the recognition of a provision, contingent liability, and contingent assets. And these are the two testing areas of the exam. So the recognition and the measurement part is kind of important. Then, of course, always there are disclosures, and there can be a short question on disclosures. So let's get started with the very basic, that is the definitions, that is the definition part in the next slide. So let's look at the definition of a provision. As you can see in this one, I will be talking about the discussion or definition of the provision, and then following we would look at contingent liability and contingent assets. So what is a provision? A provision is actually a liability of uncertain timing or amount. So it's nothing, just a liability. In accounting terms, it's a liability amount, or the amount that the company might pay in future. This might is more or less certain in this case. So it is a liability that you have to, or the company has to pay. So now you have a definition of liability here. What is a liability? Liability is a present obligation, of an entity arising from past events. So these terms here, these present obligation, past events, the settlement of which is expected to result in an outflow. It's an outflow, not an inflow, from an entity's resources embodying an economic benefit, right? So these terms here are quite important. So a provision is a liability. What is a liability? Liability is a present obligation. As I said, this is the amount that the company will have to pay at some point in time. And then, of course, you can look at a definition of what is an obligating event. An obligating event is an event that creates a legal or constructive obligation. So, of course, for a provision, there are some criteria which we are going to, this is basically recognition criteria, and we are going to look at recognition criteria of provision at the later point within this video. So this is again important. What is an obligating event? An obligating event can be from legal or constructive obligation. So let's look at the difference between legal obligation and a constructive obligation. Again, we are within the scope of provision here, but we are looking at what is the difference between a legal obligation and a constructive obligation. So a legal obligation will either come from a contract. So contract, let's say between two parties. So for example, there's a contract between a buyer and a seller. It raises a legal obligation over there. This is not a classic example of a provision, but just an example of a legal obligation. So if a sales occur, there's going to be a contract, and this will give a rise to legal obligation. Other examples could be from legislation or other operation of of law. Then we have constructive obligation. So what is a constructive obligation? Constructive obligation comes from entities' actions, right? So this comes from basically law or contract, but this is from entities' action, right? So this is quite important here to differentiate between legal and constructive obligation. Constructive obligation comes from entities' action. So for example, by an established pattern of past practice. So an example here could be, for example, company pays dividend each year. Now, if company pays dividend each year, this is a constructive obligation. This is a constructive obligation. So for example, in year 2022, there is going to be a constructive obligation or an expectation in the shareholders that the company will pay dividend in 2022 as well, right? So, and of course, you can always read these in detail. This is very important. But since the motive of this video is to do a quick summary, to explain things in simple words, but when it comes to exam, you must read all of these words and use proper accounting terms when writing your answers. So let's look at what contingent liability is, our next topic, let's say, brief topic. So contingent liability is basically a possible obligation. So this is a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events. So this contingent liability is basically based on some uncertain event. So this is basically based on some uncertain event to happen for the obligation to arise. So an obligation does not arise unless that uncertain event occurs. So we don't know, things are uncertain, and therefore it is called contingent liability. Therefore this word, therefore we have this word contingent. It's contingent, it's based on something. So therefore we have this contingent liability over there. Liability because there's an outflow. There's going to be an outflow of the resources there. That's why it's a liability. So let's look at what do we have in here. A present obligation. So we have a definition of present obligation that arises from past events but is not recognized because. So we have these two reasons why it is not recognized. So again, this is recognition part. This is recognition part here, which we will visit again. We will visit again later. Right. So you can always look at these two criteria here. Let's move on to another part of this definition here, contingent assets. So contingent asset is a possible asset that arises again from past events whose existence will be confirmed only by the occurrence or non-occurrence. Why this is an asset? Because this is going to be an inflow. This inflow is based on some uncertain future event, and therefore is contingent. Therefore this word contingent asset. So contingent asset again basically is something that company will receive in the future based on occurrence or non-occurrence of one or more uncertain future events. Let's look at the difference between a provision and a contingent liability. This is I would say fairly important because it's easy to mix these two things together. You may have a contingent liability in the exam question, and it's asking you whether you will recognize a provision or not. So you will have to analyze the case facts over there. If it's a case-based study exam, it's fairly common that student will mix up these two things, and you might say that contingent liability, you will have a provision for a contingent liability, but it really depends. There's a difference between provision and a contingent liability in this standard, and let's look at the main difference. So a provision which are recognized as liabilities. I have highlighted these in bold words, whereas contingent liabilities, they are not recognized as liabilities. Again, these two things are recognition thing as well, recognition, and we will visit these again in the later part. So a provision is basically a liability. It's very certain that there's going to be an outflow. There's going to be an outflow of resources, whereas in contingent liability, the outflow is uncertain, is very much uncertain. The company does not know. It's the outflow is not certain. It's because the outflow is uncertain, we will have this contingent liability, and you can always read these definitions here. So they say here that do not meet the recognition criteria, which we will see, and then it's not probable that an outflow of resources. So the company is basically not sure whether there is going to be an outflow or not. So that's what a contingent liability is. Let's look at the recognition requirement of a provision. A provision is recognized when these three conditions are met. So these three conditions must be met for a provision. So an entity must have a present obligation. If you want, the standard also defines what do we mean by present obligation and a past event. So reliable estimate and outflow of resources. So all these will have definitions in the standard if you're interested in. Since this video has to be brief and it's a summary, so I will try to keep it short. But if you're interested, and you must be interested, you want to know what present obligations, for your better understanding, you should read what these actually terms stand for. So entity must have a present obligation. It could be legal or constructive. We have seen the difference between legal or constructive obligation in this video. As a result of a past event, then it's probable, you see, it's probable that an outflow of resources will occur to settle the obligation, and then a reliable estimate can be made for the obligation, right? So there should be, if you want to remember it in brief terms, there should be a present obligation, probable outflow of resources, and then a reliable estimate. If you want a mnemonic for it or an acronym, you can remember it by saying PPR. So present obligation, P stands for present obligation, probable outflow, and then a reliable estimate can be made. If these conditions are not met, no provision shall be recognized. So all these three conditions must be met in order for a provision to be recognized. Let's look at the recognition requirement for contingent liability. A contingent liability is never recognized. It's disclosed. Contingent liability can turn to a provision at some point in time based on the events, and then you would recognize a liability. But a contingent liability by itself is not recorded, and it's rather disclosed. So if it becomes probable, that's why I have highlighted this in gold and red. If it becomes probable, you have to look for this keyword probable, that an outflow of future economic benefit will be required for a previously dealt contingent liability, a provision is recognized. You see, a provision will be recognized then. So you have to look for these keywords. If the event becomes probable and there's a future outflow of a future economic benefit or of a previous event, then that will turn into provision, and then a company will record a liability. Moving ahead with contingent assets, it's pretty much the same. It's just that from liability, we went to asset. Again, you do not recognize contingent asset unless it becomes virtually certain. This is very, very important, very very important keyword in here. You have to look for this keyword in the exam. If it's there, then you can recognize a contingent asset in your financial statements. You can recognize then an inflow. There would be an inflow, of course, because it is not a liability. The asset and the related income are recognized. You see, then they are recognized. If the contingent asset is virtually certain, only then company will recognize it's in financial statements. Otherwise, if it's probable, the entity just discloses. This is another keyword, another keyword. So if it's probable, then the entity will only disclose the contingent asset. So let's look at the second last part, which is the measurement of provision, right? Because it's the provision that we recognize in financial statements. It's the provision that's recognized in financial statements. So for a provision, how would you measure a provision? Now that's another question. So the amount to be recognized as a provision is the best estimate of the expenditure, because it's an outflow. It's going to be expenditure and not income. Required to settle the present obligation at the end of the reporting period. Again, these are definitions. So what do we mean by best estimate? What is the best estimate? So this is what is the best estimate. It's an amount that an entity rationally expects to pay to settle the obligation, right? So it's a rational amount that company expects to pay. Of course, there are several methods. For example, there's expected value method, and we will look at an example. There's expected value method, and then if it's individual item, then if it's single obligation, right? Then individually, most likely outcome, individual payment, one payment for a single obligation that will be paid by the company. So let's look at an example of what expected value method is to measure a provision. So this is measurement of provision, expected value example, and I will highlight it. So you can stop the video and read this. This is very important for your reading practice of the exam, because in exam you will be facing huge case studies, and you have to be pretty fast in reading and understanding, because you have time constraint, time management thing over there, and you have to highlight. You have to pick up the most important information that is required to answer the question. So understanding of question is equally important before reading your case study. So in this case study, either there are going to be no repairs. There are certain things here. Either there are going to be no repairs, minor defects, or major repairs. We have the probability of these things. So 75% will have no defects, 20% of the goods will have minor defects, and 5% of the goods will have major defects. So we have these probabilities in here. If there are no major repairs, of course, company will incur no expense. But if, let's say, there's a minor defect in the product, and 20% of them may have minor defects, company is expected to pay 1 million of the cost. So I have highlighted these things here. So 1 million of this cost. So you will simply multiply 20% times 1 million, right? And if it's a major defect, the probability of a major defect is 5%, and company expects to incur 4 million in the repair cost, and we will just multiply 5% by 4 million. And we just sum them up. We sum this probability times the sum that you pay. The company is expected to have a provision for cost of repairs as $400,000. So this $400,000 is the provision amount. Of course, you should, as I say again and again, you should read your learning pack or the standard by itself for more detailed explanation of these things. The last thing that we are going to look at is the disclosures. Disclosures, if you read this disclosure part, this is basically reporting the change in provision, during the year. So you start with the carrying amount, beginning carrying amount, and the end of the period. You report additional provisions made in the period, including increasing to existing provisions, or it could be a decrease in provisions as well. Amounts used, that is incurred and charged against the provision, right? Unused amounts reversed during the period. So these are all part of the change in the provision. And plus, I would like to mention here that there are other disclosures as well, which can be referred from the standard directly. So you can always visit the standard directly. I will put a link in the description box below to the standard, so that you can refer to the standard easily, and you can see other details of the standard by yourself. I hope this video was helpful to you. If you like this video, please give it a thumbs up and subscribe to my channel for more accounting videos like these. Thank you very much.